Thank you for taking time out of your day. My name is Joshua Patz, and today I am going to go over the best options for financing a business. I'm going to start off by just going over a little bit about entrepreneurs and exactly what they do. We all know these are typically people that start businesses. They take the initial risk, typically is considerable initiative for them. We all know the massive examples out there that we all have for who entrepreneurs are, as listed here: Bill Gates, Steve Jobs, of course, many other ones that aren't named that we really don't know about or study that are out there. Functions of entrepreneurs, range from the planning, from the business plan, the decision making, organization, management, the uncertainties. They even have to be able to be innovators. Come up with new products, ideas, or ways of even doing business, as well as finding the right financing. So you go through the stages of the process here, and you got the conducting opportunity analysis, the developing, determining resources, and scaling and harvesting from the venture. Hopefully it's profitable. However, the big one here and the one I'm going to focus on is the acquiring financial partners and sources of funding. And these are the big ones that I'm going to touch on here on ways to finance. The self-financing, family and friends, bank lending, credit cards, other options, business trade credit, and angel and venture capitalists. So let's get started here with self-financing. Before we really get into that, I just want to go over that. Large companies don't struggle as much with finding money. They have a number of options to depend on to raise capital. However, with the small business loans or small businesses, they do struggle to come up with financing. They don't have the revenues that are out there, or they haven't been open as long, or they're trying to get started. So it can be challenging to find capital to operate their businesses. It's however, these problems can be sidestepped with finding financing if you develop the business plan correctly, your financial plan, really know your business. But let's get started with the self-financing. This is how most startups really go about um, gaining financing. It's from themselves. Uh, you know, whether they have some form of asset, uh, savings account, that's money they've saved up, investments, even inheritance. They get money, uh, and as well as collections. Maybe they have a car collection, stamp collection, something that's just worth a lot of money that they can put up as collateral to gain financing. Home equities are one of the biggest ones. Business owners, they have that option of tapping into that equity that's built into their house to help further operations or even start a business. They have many advantages, typically lower interest rate, and you can have a portion of your taxes deducted from the interest that you pay. This is over the last I'd say 10 to 12 years. This has really become a really big option since the rates have really dropped. Uh, Probably the lowest they've been in this decade. However, there are disadvantages here, and you're putting your home at risk. Your business goes under. You're placing a big bet that you could lose your home. So there are other ways, and another option here is family and friends. Family and friends are one of the most conventional ways of financing small businesses. Many entrepreneurs have been able to leverage existing relationships. They've obtained funding either as a loan or as a capital investment for their business. However, the source of funding can be easier to obtain. It has a lot of problems. First, the business owners put risk of, or they place relationships at risk. Um, you know, no one expects the business to fail, but if it's not doing good, how are the relationships going to react? Furthermore, transactions are usually done with little formality. There's not a lawyer, not written agreements, um, which can really complicate, this complicate matters even worse. Uh, if this is an option that you do look at doing, uh, you should consult an attorney and draw some formal documents. Um, it lays out the responsibility of each partner. Now you also have credit cards. Uh, this has become a very popular route as well, typically used with the smaller startup companies. Much like line of credits, business owners use credit cards to fund their business. It offers it gives them the ability to make purchases, obtain cash, and even so they can pay it at a later time. However, this can be a very expensive source of funding. Um, your interest rates are really typically going to be a little bit higher. You might get an introductory rate that's pretty low. However, the interest rate sometimes can be 17, 19, even a little bit higher. If you have delinquency problems. Um, However, uh, it's not really guaranteed. This method of financing is risky. Uh, if it doesn't produce the results, uh, you're still stuck with the credit. So you should use this option very limitedly. Be very cautious going into using credit cards and getting in credit card debt. Next one is again on the bank lending, going into the home equities, but this is touch base on the home equity. This goes in a little bit deeper. Uh, Getting any time if you have any type of collateral, using that. You know, Typically you go to your bank, you try to obtain some loans or something, a line of working capital. Um, this is not typically the greatest option you have. Uh, Banks are typically pretty cautious about who they lend to. They do want to see, typically want to see a couple years in, in the business. So it can be a little harder to get this. Um, Again, because banks are very cautious. There is the Small Business Association, um, which does help. Um, there's a lot of funding out there that we don't realize that is out there that the government's willing to help with. It does make it a little bit easier. They're willing to take a little bit more risk than the banks are willing to take. So there is money out there. It's typically a little bit harder, to get it. There's a lot of work, a lot of paperwork has to be done. This is why your business plan is such a big deal. Having this available and being able to go out and show this to the banks and the possible lenders. The other lenders, for for established businesses, typically the biggest one would be invoice factoring. And this is where accounts receivable financing, also known as invoice factoring financing. Um, it's a source for working capital for mainly larger companies. They've been using it for decades. Invoice factoring enables businesses to sell their slow-paying account receivable to finance companies, who in turn, they pay this invoice, and then you pay it back when you're paid, based on your account receivable. It's not a great method for the smaller businesses or the startups, but it is an option that should be considered. And there's there are options out there like this. Going further, we have the business trade credit. This is probably going to be one, like it says, the biggest source of credit that's out there for mainly your established businesses, um, that have gotten their name out there, that have proven what they can do. Typically do have to have a well documented, prepared financial plan. It really helps you negotiate on what the credit line is, or how you can go about doing it. This is pretty much anytime you take delivery of inventory, equipment, material, or anything else, without paying for it up front is typically this business trade line credit. Again, it is one of the biggest sources for capital, used worldwide. And again, it's for the typical larger companies. And going from there, we have what we hear a lot of in school and classes are the venture capitalists and angel investors. They're becoming really big. They are different, but again, they still are the same. Venture capitalists really isn't as simple as you think. There's many books, publications that tout the benefit of this for financing new or for ongoing operation. However, venture capitalists is an option for small businesses that have a seasoned management team and very aggressive growth plans. However, they rarely invest in small businesses that have no intentions of going public. They are looking for businesses that do want to go public. That is one of their biggest ways of how they make money on it. And they're looking at doing it pretty short period of time. Another one's the angel investors. Typically really wealthy individuals or even a group of individuals that look to help startup companies or even, again, with the ongoing operations. This is typically for the companies that don't meet the venture capitalist requirements or the manager's influx. However, don't rule out the angel investors or the venture capitalists. They do focus on, real big in certain communities. They will invest in the small businesses. Typically, the best way to find these angel investors or, through research or networking is a good way, to go about finding this. Again, there's multiple options out there. These are just a few of them. There's multiple ways. Get creative. You can go, with product pre-sale even, with trying to pre-sale products before you make it, just to get, to raise money that way. There's also opening side businesses. You can open a business that's, I guess, almost like double dipping, but it helps fund startups. This has been used for a while, and there's multiple companies that do use this. But you can also go with selling assets. Just finding things to sell off to make some money. And you can even get into credit card balance transfers. So again, you probably not the best way, but it is out there that you can transfer balances on a credit card to help get startup costs. So again, there are multiple ways out there. Again, Citadel's even now offering multiple different contests for business plans to help you, gather, investments or get into a brooding company to where, it makes it a little bit easier on you to stay in business. Again, thanks for taking the time to listen. Have a good day.